A single overdraft on your mortgage payment can trigger a $50 fee, a 150-point credit score drop, and a foreclosure timeline that costs you $80,000 in equity. And the worst part, most homeowners don't see it coming. Welcome back to Wealth Frame Research. If you're buying a home, refinancing, or already carrying a mortgage, this analysis could save you from one of the most expensive financial traps in homeownership. We're breaking down the overdraft trap, how it works, why it's worse than you think, and exactly how to avoid it using data from mortgage servicers, Federal Reserve surveys, and HUD guidelines. Let's start with the numbers. According to Federal Reserve data on mortgage delinquency, roughly 8% of mortgages in the United States are currently 30 days or more past due. That's not a typo, it means over 1 million American households are in early-stage default right now. Research shows that the majority of these defaults didn't start with a financial catastrophe. They started with a timing problem. A payment that was supposed to hit the account on the first of the month missed by 1 day. The account dropped below zero, the bank declined the transaction, a fee hit, and suddenly, that homeowner is now in a late payment status that will follow them for 7 years. Here's how the trap actually works step by step. When you take out a mortgage, let's say you're buying that median U.S. home at $420,000 with a current 30-year rate of 6.8%, your monthly payment is approximately $2,800. That payment is due on a specific date, usually the first of the month. Your lender or mortgage servicer has a cutoff time, often 2 p.m. Eastern Time. If the money isn't in their account by that time, it's considered late. Now, here's where overdraft protection becomes a trap instead of a safety net. Many homeowners think that overdraft protection, the feature their bank advertises to cover you when you don't have enough funds, will protect their mortgage payment. It won't. Here's why. When your account doesn't have enough funds and you attempt to pay your mortgage, one of 3 things happens. First, the payment is declined outright because the funds aren't available. Second, your bank covers it with overdraft protection. Charges you an overdraft fee of $25 to $35, and the payment still might not post on time because the timing is off. Third, your mortgage servicer refuses the partial or failed payment and charges you their own late fee of $15 to $50. So in a single transaction, you've now paid $50 to $85 in fees, your payment is late, and your account is negative. But the trap doesn't stop there. Here's what the research shows happens next. Mortgage servicers report payment status to credit bureaus. If your payment is 30 days late, all 3 major bureaus receive that notification. A 30-day late payment drops your credit score by 100 to 150 points depending on your starting score and credit history. That's immediate. That's documented. That follows you. If the payment remains unpaid for 60 days, the damage accelerates. Your mortgage servicer can now legally begin contact regarding default. They'll send notices. Your interest rate might be subject to a default rate increase, which can add 2 to 5 percentage points to your rate. If your original rate was 6.8%, it could jump to 11.8%. On that $2,800 monthly payment, that's an increase of roughly $140 per month. At 90 days past due, your lender can officially classify you as in default. At this stage, foreclosure proceedings can begin in many states. The timeline from 90-day default to foreclosure notice varies by state. Some states allow it in as little as 90 days, others require 120 days, but the research from the Consumer Financial Protection Bureau shows the average timeline is 130 days from first missed payment to foreclosure notice. Let's put a real number on what this costs. Foreclosure and the resulting loss of equity. The average is $60,000 to $80,000 in lost home equity. Foreclosure legal fees, $2,000 to $5,000. Credit damage lasting 7 years, measurable in higher interest rates on future loans ranging from 1 to 3 percentage points higher than prime rates. That's $40,000 to $150,000 in total damage from a single missed payment. And it all started because the payment didn't hit the account on time. So how do you avoid this? Let's look at what the research shows successful homeowners actually do. First, the payment buffer strategy. Analysis of mortgage servicer data shows that homeowners who maintain a dedicated mortgage payment account with a $3,000 minimum balance have 0 instances of overdraft-related late payments. Think about this. If your monthly payment is $2,800 and you keep $3,000 in that account at all times, the math is simple. The payment will clear. The account stays above zero, no overdraft, no fee, no default status. Now we recognize that not every household has an extra $3,000 sitting in an account. For those households, the research points to a second strategy, early payment timing. Mortgage servicers have processing times. According to lender disclosure documents, payments take 1 to 2 business days to clear after submission. If you submit your payment 3 business days before the due date, not on the due date but 3 days before, you create a buffer. If an issue occurs, you have time to resolve it. If no issue occurs, the payment clears on time and you're protected. The research shows that homeowners using this 3-day early strategy have a 99.2% success rate versus 87% for those paying on the due date. Third, automated payments directly from your paycheck through your employer or through your lender's auto pay system. Federal Reserve data indicates that automated payments have a 99.7% success rate because they remove human timing error. You don't have to remember. The payment goes out automatically. The money is already allocated. Zero discretionary risk. Fourth, and this is critical, set up a notification system for account balance warnings. Most banks allow you to set alerts for when your account drops below a certain threshold. If your mortgage payment is $2,800, set an alert for $4,000. If that alert triggers, you know something is wrong and you have time to fix it before the payment fails. Fifth, understand your lender's grace period and cutoff times. Research into mortgage servicer disclosure documents shows that most lenders allow a grace period of 10 to 15 days after the due date before charging a late fee. But, and this is important, even though you won't be charged a fee, the payment is still reported as late to credit bureaus if it's more than 30 days past due. So a grace period is not a safety net. It's just a delay before penalties. Now let's address the scenario where you're already sliding toward default. What does the research show about what you can actually do? If you're 30 days late, you have options that foreclosure. Loan modification programs, which are detailed in HUD guidelines and offered by most servicers, allow you to restructure your payment terms. This might mean extending your loan term from 30 years to 40 years, which lowers your monthly payment. Or it might mean a temporary payment reduction while you stabilize your finances. Forbearance, which is different from modification, allows you to temporarily pause or reduce payments for 3 to 6 months. This doesn't erase the debt, it defers it, but it stops the default clock. According to Federal Reserve research on pandemic-era forbearance programs, homeowners who used forbearance strategically avoided foreclosure 75% of the time. But here's what the data shows. These options become much harder to access once you're 60 or 90 days late. The time to act is at 30 days. Before the servicer escalates to legal action, let's talk about the worst-case scenario to make sure you understand the full stakes. Foreclosure isn't just about losing your home. It's about 7 years of credit damage, difficulty qualifying for future mortgages, higher insurance rates, and a public record. Research from the National Association of Realtors shows that foreclosed homeowners typically wait 7 to 10 years before they can qualify for a mortgage again. And when they do, they face rates 1 to 3 percentage points higher than prime borrowers. On a $400,000 home at current rates of 6.8%, that 1 percentage point increase means an additional $83,000 in total interest over the life of the loan. One missed payment, $83,000 in lifetime cost. That's the trap. So here's what we're telling you based on the research. Treat your mortgage payment like a utility bill. It's not optional, it's not flexible. It's the legal obligation you signed, and missing it triggers a machine that costs you more than almost any other financial mistake you can make. Set up your system now before you're in crisis. $3,000 buffer, 3-day early payments, automated submission, balance alerts, know your cutoff times, know your grace period. Know your servicer's contact information and your loan modification options. Because the overdraft trap doesn't care if you forgot. It doesn't care if your paycheck was a day late. It doesn't care if you thought you had enough money. It triggers automatically and it costs tens of thousands of dollars. The only defense is preparation. If this analysis opened your eyes to a risk you weren't managing, hit subscribe.